This is Nightly Business Report with Sue Herrera and Bill Griffin.
Hiring spree. The economy's job engine shifts into overdrive, sending the unemployment rate to an 18-year low and stocks soaring.
Not Sam Walton's Walmart. The world's largest retailer is going high-tech to transform its business and attempt to disrupt the ultra-competitive retail industry.
The accidental entrepreneur, how one woman turned a hobby into a multi-million-dollar fashion business far from the bright lights of New York or Los Angeles. Those stories and much more tonight on Nightly Business Report for this Friday, June the 1st.
Good evening, everyone, and welcome. Phenomenal, solid, packed a wallop. That's just some of the ways that people describe the May jobs report, which saw the unemployment rate fall to 3.8%, matching April of 2000 as the lowest reading since 1969. Even wages, which have been stuck in neutral for some time now, rose modestly, and that sparked a jobs-fueled rally on Wall Street. The Dow Jones Industrial Average advanced 219 points to 24,635. The Nasdaq rose 112, and the S&P 500 gained 29. Hampton Pearson takes a closer look at what's driving all that hiring.
The private sector was on fire in May, hiring 218,000 new workers, pushing the unemployment rate down to 3.8%, an 18-year low. Job growth was widespread. The retail sector led the way with 31,000 new hires, followed closely by healthcare, up 29,000. Improving weather boosted construction employment by 25,000. And revisions show the economy actually created 15,000 more jobs than previously reported in March and April.
It is a strong number. It's great. We should be celebrating that over the last 6 years, we've come back from a terrible downturn, and we're now in a pretty good spot.
This week, the Fed Beige Book reported labor markets getting tighter, with shortages of skilled workers in many parts of the country. The trucking industry in particular is sounding the alarm. There's a shortage of 50,000 truck drivers nationwide, according to the American Trucking Association. The Transforce Group, headquartered in Alexandria, Virginia, has nearly 10,000 drivers on the road in nearly 30 states. Business is booming, but there's fierce competition to hire drivers, and wages are skyrocketing. Transforce founder and CEO David Broom says wages have really spiked in the last 6 months. 5% a year is the new normal.
Today, right out of a truck driver training school, the beginning wages are around $45,000 to $50,000 a year. That's really great for a new entry opportunity in today's world. And what we're seeing as you go through and how much you're willing to work, and if you're going over the road or if you're staying local, those ranges can go up to $75,000, $80,000, and even $100,000 a year as a truck driver today.
Year-over-year wage growth stands at 2.7%. No alarm bells yet from monetary policymakers when it comes to inflation, but leading economists see those just-announced trade tariffs as the new wild card.
Look, the tariffs themselves are very small. The big tax here is uncertainty. Washington needs to let people know what the game is, the rules of the game, then American business can invest.
The jobless rate is falling faster than Fed forecasts, and there's new data showing industrial production and consumer spending on the rebound. Fed watchers see an all-clear signal for a June rate hike. What happens after that depends on which way the trade winds are blowing. For Nightly Business Report, I'm Hampton Pearson in Washington.
Let's take a deeper look now at this jobs report and what it means for the economy. Joining us tonight to talk about it, Mark Zandi. He's chief economist at Moody's Analytics. Mark, good to see you again. Welcome back.
Hi, Bill.
How much lower does the rate go? How much tighter does this job market become? And do you expect to see wage growth start to pick up even more now?
Yeah, unemployment's going a lot lower. We have all this fiscal stimulus debt ahead. That's deficit finance tax cuts, deficit finance government spending increases. So just a little bit of arithmetic. Unemployment will be in the low threes, could be even below 3 by the end of the decade. That's rarefied territory. We've only been there 2 other times in history, and that's when we were in war, World War II and the Korean War. So very, very low unemployment, very tight labor markets. I think wage growth and price pressures will develop. The real risk now developing is that the economy will overheat.
And that means inflation will creep up as well. What does that do for the Fed? Does it change their trajectory in terms of raising interest rates?
Well, they think they have said that they're going to normalize rates, raise rates. Right now they're expecting to raise rates a couple more times this year, 3 times next year. But I suspect that as unemployment goes lower and those wage and price pressures develop, that they'll have to raise rates more aggressively. So in my view, I think they're going to have to raise rates, 3 more times this year, 4 times next year. Rates are going to go much higher.
We hear about the shortage of truckers. We know how tight the market is and how it's tough to find qualified employees in the technology sector. Healthcare is doing very well. Construction's picking up here. But if you see unemployment going below 3% at some point, how much tighter is this market going to be? Companies are going to be scrambling for employees, won't they?
Absolutely. It's already, I think, for most businesses, their number one problem, finding and retaining workers. And that's only going to get worse. I mean, the Bureau of Labor Statistics puts out data on the number of open job positions. It's at a record high. And if you look across every single industry, even surprisingly, go look at retail, where the brick and mortar retailers have been hit pretty hard. We have a record or near record number of open job positions. And that's now at a 3.8% unemployment rate. Can you imagine what it's going to be when we're at 3% unemployment? And adding to the pressure is immigration. We're tightening down on immigration of all skill levels, and that's just going to exacerbate the problems that businesses face filling those open positions.
All right. A good problem to have, I guess, at this point. Mark Zandi with Moody's Analytics. Thanks for joining us tonight.
Thank you.
Well, investors watched as President Trump said the summit with North Korea was back on. After a rare meeting with officials from Pyongyang today at the White House, the president said the 2 nations will meet as originally planned on June 12th. The official met with the president for more than an hour and delivered a letter from North Korean dictator Kim Jong-un.
There was also positive news from the manufacturing industry today. The ISM Manufacturing Index showed activity expanded at a faster pace than forecast last month. That would be the 21st consecutive month of sector expansion.
And the strong labor market and the high consumer confidence are driving Americans into the auto showrooms. Overall, 2018 is on track to be one of the 5 best years ever for auto sales, even though the pace might be slowing just a bit. Phil LeBeau has more on what's in demand.
While prices in the showroom and prices at the pump may be rising, America's love affair with pickups and SUVs is still running hot. In fact, Jeep sales surged 29% last month, pushing Fiat Chrysler's May sales up 11%, better than expected, which was also the case for Ford, while Toyota posted a slight decline last month. As for the best-selling vehicle in the country, the F-Series pickup, Ford had plenty in stock to grow sales in May, despite a fire at a supplier's plant knocking out F-Series production for a couple of weeks last month. Overall, 2018 is still on pace to be the 4th straight year with auto sales topping 17 million vehicles. Fiat Chrysler expects auto sales to remain strong over the next 5 years, during which the company plans to double global sales for Jeep and expand Ram's business in North America. The strong economy is what's driving auto sales right now. It is also convincing consumers they can afford to buy the new model that they're looking at. In fact, the average auto loan payment for a new vehicle is now at a record high, $523 a month. Phil LeBeau, Nightly Business Report, Chicago.
Walmart is embracing change. At the company's shareholder meeting today, the CEO said change is a key part of his company's strategy, and that transformation involves going high-tech to stay one step ahead of competitors. Courtney Reagan is in Fayetteville, Arkansas for us tonight.
While Walmart is still focused on its founding principles of low prices and customer service, the company has come a long way from Sam Walton's original vision as technology changes how Walmart operates and how its customers shop. Walmart executives spent Shareholders Week talking largely about the role technology is playing in the business and previewing what's to come. This is one of 50 Bossa Nova robots Walmart is using for inventory management. The robot's mission is to make sure products are where they are supposed to be, in stock and priced correctly. That information is sent to an internal app so store employees can make changes when needed. The robot currently scans food and consumable products up to 2 times a day and the rest of the store once. Without robots, the scans are done once every 2 weeks. 30 Walmart store stockrooms are using one of these fast unloaders, a system using various technologies to unload delivery trucks faster and with 4 instead of 8 employees. It makes the unloading and restocking job much easier. Important because it's the job with the highest turnover in the store. Now those workers can spend more time helping shoppers. Walmart also runs its own tech incubator. It's called Store Number 8, and its mission is to identify the new game-changing technologies that will power retail in the future. Rent the Runway co-founder Jenny Fleiss works for Store Number 8 and is now running the first program to come out of that business.
Jet Black is a personal shopping service over text message. It's a membership model, so we charge a monthly membership fee. It offers frictionless delivery and shipping.
Jet Black is just one of many new programs that Walmart is experimenting with to change the way it has traditionally done business.
Walmart's always been the disruptor, and we still are. We've done things differently. We still do.
We're positioning ourselves for sustained growth while at the same time finding new ways to serve customers today. We know we ask our shareholders for patience sometimes so that we can set this business up for long-term success.
While Walmart got a late start when it comes to some of its digital strategies, it's working hard to play catch-up to be a better place for its employees to work and for consumers to shop. For Nightly Business Report, I'm Courtney Reagan in Fayetteville, Arkansas.
It is time to take a look at some of today's upgrades and downgrades. American Airlines was upgraded to outperform from in-line over at Imperial Capital. The analyst expects the airline to reduce capacity sometime after Labor Day. The price target is $56. The shares rose 1% to 44 even. That same analyst at Imperial Capital downgraded shares of Southwest to in-line from outperform. The analyst cites heightened competition in the California market and potential weakness in the Denver market. The price target is $54 and the stock fell just a fraction to $50.96. Twitter's price target was raised to $43 a share at MKM Partners. That is the highest price target on Wall Street. The analyst cites a strong digital ad market, and the firm also says Twitter could see a sales boost from the World Cup tournament. Twitter shares rose more than 5% to $36.65.
Still ahead, why our market monitor is not running from European stocks given the trade tensions and political drama. Instead, he's investing in them.
Boeing workers vote for a micro-union at its South Carolina plant. Last night, a small group of employees at the company's jetliner factory voted to unionize. The plane maker plans to challenge the vote's legality. The National Labor Relations Board recently made it tougher for workers to form unions made up of small groups of employees.
Rising trade tensions between the U.S. and its largest trading partners are creating uncertain futures for America's farmers. Our Aditi Roy reports tonight from a farm in Stockton, California.
Well, I'm looking for if there's more than 2 apples in a bunch.
Jeff Colombini's been growing gala apples along with cherries and walnuts for 30 years on his 1,800-acre farm in Stockton, California. The galas are still young and green right now, but by the end of July, these apples will be ready for harvest, eventually ending up in stores like Walmart and Sam's Club.
How are the apples looking this year?
Apple crop looks very good. I think we're going to have some great quality apples this year.
But he also exports a quarter of them to Canada and about 10% to Mexico. And now with trade tensions rising among the U.S., its NAFTA partners and the EU, Colombini's worried.
What's kind of going through my mind is here we go again, because unfortunately when there's any sort of a trade dispute, agriculture always gets targeted first.
There's a lot at stake for U.S. farmers as leaders exchange tough words amid President Trump's announcement of tariffs on steel and aluminum from Canada, Mexico, and the EU.
You just don't know what's going to happen next.
Last year, the U.S. exported $43 billion worth of agricultural products to Canada and Mexico, while importing $47 billion in farm products, according to the U.S. Trade Representative.
It's frustrating in that Canada and Mexico have been very good trading partners with the United States.
The president claims the U.S. is being taken advantage of by those trading partners. Just this morning, President Trump tweeted, "Canada has treated our agricultural business very poorly." This after Canada and Mexico have fired back with their own list of tariff targets, which include agricultural products like beef, grapes, and apples.
If I have to dump or not harvest 25% of my apples, it means I'm not going to be making a profit this year, and I'm going to have a hard time paying my employees.
Colombini says 3 decades of farming has made him used to uncertainty.
You've seen a lot of trade disputes like this during your time.
Yes, I have.
While there's a lot of hand-wringing among farmers, some agricultural trade groups like Farmers for Free Trade are also speaking out, saying that tariffs will take many U.S. farm operations to the breaking point. For Nightly Business Report, I'm Aditi Roy, Stockton, California.
Abercrombie & Fitch wants to get more shoppers into its stores, and that's where we begin tonight's Market Focus. The clothing retailer, which is in the midst of a turnaround, reported stronger margins and an increase in same-store sales, but it acknowledged it is not seeing a steady flow of customer traffic just yet. That pressured the stock, which fell more than 8% to $21.77. The CEO of the Brazilian petroleum giant Petrobras stepped down from his role after facing criticism over how he set gas and diesel prices based on the cost of oil. Brazil recently lowered the price of diesel fuel in that country after truckers went on strike to protest the high costs. Shares of Petrobras plunged 14% to $10.13.
Shares of Workday remained under pressure today after the enterprise software company reported slower quarterly revenue. That was after the bell last night. The company did raise its guidance, though, for the full year, but investors weren't having it. Shares finished down more than 3.5% to $126.29. Meanwhile, shares of Marvell Technology rose today after the chip maker delivered an earnings and sales beat last night. The company also sees earnings for the current quarter topping expectations, and shares were higher by nearly 3% to $22.17.
Well, even as those trade tensions remain a hot-button topic, tonight's Market Monitor says he likes ETFs with exposure to the global markets. This is his first time on as a Market Monitor. He is Peter Maluk. He's the Chief Investment Officer at Creative Planning. Welcome back, Peter. Nice to see you again.
Thanks. Good to be back.
So you are embracing the weakness that we've seen across equities, and one of your picks we'll start with, they're all ETFs, shares emerging markets, EMG. Why do you like it?
Well, if you look at the dividend yield and the PE ratio, just from a valuation standpoint relative to the United States, dividend yield's almost double. The PE ratio's a little less than 15, so below historical norm. You compare it to the United States, above the historical norm with double the growth rate. So yeah, you're dealing with a lot of turmoil. There's a reason it's a value, but this is a nice entry point for somebody accumulating.
You're, the second one, you've got the Vanguard Developed Markets. Now, it's suffered because of the fears about the trade wars and things, but you're among those who feel like that's been overblown in the market, right?
Yeah, I mean, I think you have all kinds of things impacting that, the Italian debt crisis, the strength of the dollar, but mainly the threat of a trade war. I don't doubt for a second that we're going to have spats and there's going to be more to come from a I don't know if you want to use there seems to be no intermediary word. It's either nothing or trade war, but there's going to be something that continues to happen before this all settles down. But I think it's overblown because it's not in anybody's best interest to have a prolonged trade war, including the United States. I think this is all posturing and a little bit of back and forth for the United States to get a slightly better deal, and you'll see that lift a little bit. And if you look at how the markets have performed year to date, with the U.S. just barely up and overseas just a little bit down, you can attribute most of that overseas weakness to this potential trade war.
And if you want to reach for better growth or maybe stronger growth in that sector, you like the VSS, Vanguard All World ex-US small caps. Why?
Yeah, I think if you look at the small cap space overseas, it's got everything everybody doesn't like put together. So you're going overseas, then you're going to the most unstable part overseas with emerging markets, then you're going to the smallest, most vulnerable companies. And you look at that, you get a dividend yield that's more than double small cap US with, again, a higher growth rate. And if you look at the general backdrop, it's very positive. They've got strengthening earnings, declining unemployment, a high growth rate. There's some very big strong fundamentals in the background, but there are legitimate reasons in the short run it's a value. And so again, if you're willing to enter and be patient, this is, you can't argue from a valuation perspective. People look at the United States and say, I don't want to get in because it's too expensive, and overseas, I don't want to get in because it's too dangerous. Well, you know, it's expensive when things look really good, and it's a value when things aren't perfect, and that's what's being presented right here.
Let me push back just a little bit here in Europe. You know, some of the political turmoil that is going on there. You know, the UK is still in the midst of trying to figure Brexit out. Yeah. Italy's trying to get a new government together here. The Spanish prime minister was just voted out, lost a vote of confidence there. I mean, these are real problems that are still going on over there.
I mean, those are definitely real problems, and they carry over from Europe throughout the emerging markets, which are even more unstable. And I think, to your point, that's part of what's being priced in here. But at the end of the day, these companies are still pointing strong earnings, and their earnings are getting stronger. They're just lagging the United States a little bit. I think in general, the markets see that. I mean, last year, even though there was a lot of talk about how well the United States did post-election, we underperformed the international markets and the emerging markets with most of this political turmoil already in place. And so I think that backdrop of strengthening earnings is why you don't see foreign markets down substantially despite all that's happening with Italy and everything else.
Good to see you again, Peter. Thanks so much.
Great.
Peter
Thanks.
Millett
Have a great
with
weekend.
Creative Planning. You too. For more on Peter's picks, head to our website, nbr.com. Coming up, meet the former call center operator who was a part-time fashion blogger and grew her hobby into a full-fledged successful business. It's the latest in our Bright Ideas series.
Here's yet another reason that social media is big business. I mean, celebrities, they've long been a strong influence on how the rest of us dress. But social media has turned average people, if you will, into powerful influencers as well. In fact, last year's sponsored influencer posts on Instagram led to more than $1 billion in sales. And that number is projected to double in the next couple of years. That's one reason a former Indiana call center operator got the bright idea to build her blog into a valuable resource for fashion retailers.
So cute. Love it.
If Erin Schrader likes it, her blog readers notice.
There's a striped tee.
If her readers click a product link, they shop. And quite often, they buy.
We're consistently producing over 7 figures in sales for those retailers every month.
Her blog, Living in Yellow, aims to highlight good looks at good prices. When a reader clicks a product link, Schrader gets paid. If the reader buys, Schrader might earn a commission. What started as a diary in 2011 pays quite well these days.
I am running a multi-million-dollar business.
And the Living in Yellow team makes it happen in Goshen, Indiana.
Occasionally, I would maybe go to Old Navy and pick up a few things and then mention it on the blog. And people always seemed interested in learning, not just about my life, but what was I purchasing and liking.
In 2013, Schrader noticed retailers with products to push were using marketing agencies to find and pay bloggers.
It really depends on what your traffic is. So it could range from maybe a couple $100 upwards of thousands.
Sometimes tens of thousands. Now, Living in Yellow claims more than 700,000 page views a month, and still Schrader is considered a micro-influencer.
We have a much smaller audience size than a lot of the mega influencers where we're talking millions of followers. However, our audience is a lot more engaged and converts for retailers.
Carrie Brown checks the blog daily.
Of the people I hang with, a good 75 to 80% follow the blog.
Tammy Mishler, a busy mom, can trace about half her wardrobe to Schrader's posts.
Or like, have you seen them online?
I promised my husband I would stop purchasing for a while, and so I'm on a good month streak of not purchasing.
Schrader and her blog are proof that paying attention to seemingly dry marketing data can definitely drive sales.
We have full access to our analytics, so we can see what brands people are shopping, what pieces they're buying. That helps us better shape our content.
A while back, a pink blazer just wasn't selling. until Schrader styled it, and 600 units moved. It sold out.
As soon as she posted something, we would see an immediate lift in the amount of units that sold.
That blazer carried one of Susie Turner's 3 brand labels. This year, she says about 30% of her business will come from data-driven blog posts.
It's like having a crystal ball. It's the first time that I feel like anything like this has been available.
Turner partnered her Gibson brand with Schrader's Living in Yellow to design a new line this spring.
This is the Aran tunic.
Gibson X Living in Yellow debuted in March on Nordstrom.com.
We went to Gibson and we said we want to do a tunic. They came up with the idea of doing this little cross hem detail.
With dreams of someday having her own line, it's no wonder that Schrader says the name of her blog, Living in Yellow, means living with joy.
This job is a lot of work, but it is the most fun and rewarding job. The ability to connect with thousands and thousands of women on a daily basis it's amazing.
Now, Erin Schrader buys almost all the items that she posts about, and as you can imagine, she really likes the sites that allow for free returns because one only has so much closet space. She also has turned down items that retailers have sent to her, saying that she will only post about things that she actually would wear herself.
Good for her.
Good story,
Great
isn't it?
story, absolutely. Well, that will do it for us tonight on NBR. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great weekend. We'll see you again on Monday.